Okay. Hello everybody, this is Mark Gomes with another PTT Elite Methodology in Action series videocast. You know the drill, so I won't take you through it. Let's just jump right in. Keep things to the point. A lot of folks obviously losing money this week. JAKKS specific, we're going to talk about. We're going to take a step back for a sec and talk about the market in general. And when I talk about the market, of course, I'm talking about the Russell. The Russell 2000 is the small cap index that my methodology is primarily focused on because the small caps are what outperform over time. If you look at the studies that we did in the past, over the past 6 decades, going back to the 50s, in each decade, the small cap value stocks has been the best performing asset class. And small caps in general have been the best performing asset class in general amongst equities. Okay, so if you are a long-term investor, which is what PTT is all about, investing, this is where you want to be. Okay. Now, if we look at what's happened over the past year, going back to my yellow alert in November of last year, we had obviously a decline here. My other yellow alert that took place, actually didn't take place. The air attack took place in early July, I believe, but somewhere closer to there, thereabouts. I don't like to nitpick. It could be down low or up high. Regardless, the market has obviously performed very poorly since that time. Okay, and in fact, if you look, we are nowhere. The market has gone absolutely nowhere. So the average Russell stock, that is 2,000 stocks. This chart represents what the average of those stocks has done, how those stocks has performed. Okay, so if you've been losing money over the last several months, welcome to the club, because 2,000 stocks on average have been down over the last several months. Since July 1st, the Russell has been doing nothing but going down, with 2 steps down, 1 step up, 2 steps down, 1 step up. We'll see what the next step is here. Of course, I can't predict that. However, my yellow alerts are based on the longer term risk reward of the markets, which, as I've been saying, became very stretched at these levels, largely because of the fundamentals of the market, combined with where the market is/was in the risk reward channel. And by the way, I think this line is too high. If we look at a long-term view of the market, I can only draw a straight line. This line should actually be curved, because this line has been 6%. See that? It's growing at 6% per year for decades. But the reality is that US GDP growth has been slowing for those decades. And of course, risk reward lines are based on growth. And since growth is slowing, then this curve, this line should actually be moving at a lower slope as time goes on. So it should look more like a curve than a straight line. So my guess is that this part of the line would be a little bit higher, this part of the line would be a little bit lower, and therefore it's a pretty strong belief on my part that this point in time represented the highest level that we're probably going to see in the stock market for a long time. And in fact, if we pull this back into a future chart, a lot of you folks don't have a lot of experience in the market or memory or even care to remember perhaps how bad things were from 2000 to 2002 and in 2007, 2008. And there were several instances prior to that in history, the 70s, a good example, where the market does nothing but go down for years. Okay, the Russell went down for 1, 2, 3 years. Okay, back here, and it was down for 1, 2, about almost 2.5 years. Here, years. Okay, we've only been dealing with months. If you think you've felt pain over the last few months, it's only getting started unless you are focused on the methodology, which we're going to talk about again to reinforce its values. And before we do, just take a quick peek at where we are here. We're right about here on this chart. Okay, this dashed line represents where we're at right now. Everything underneath that dashed line, everything down here, represents where the stock market could go next. And if you notice, if we look at this dashed line coming across, it's not until 2023. See down here, this is the year 2023. It's not until then that we get to the point where the market should definitively be above a higher level than where it is right now. In other words, if the stock market gets to the bottom of its risk-reward line anytime in the next 9 years, we are going to have an opportunity to buy stocks at a cheaper price than where they are today. And as you notice, in 2009, we hit the risk-reward bottom. In 2011, we almost hit it. In 2002, we hit it. 2003, we hit it again. In 1992, we hit it. And in 1993, we hit it. So we have 1, 2, 3, 4, 5, almost 6 instances of hitting the bottom of the risk-reward chart over the past 22 years. So on average, we hit the bottom of the risk-reward chart once every 4 years. And it hasn't happened since 2009. Okay, so we're overdue. If you look at this, just common sense would dictate you say, oh, this is the movement we get. There's a sharp move that we haven't seen in a while. So even if we get a halfway move, that was like a halfway move that didn't get us down to the risk reward line. If we get one of those, then we see the S&P drop to, let's say, 900, even being conservative. That's 20% down from here. Okay, and if we go all the way down to the bottom of the risk reward line, you're talking 750. If we get one of these big rounding patterns like we got, rounding pattern, you see how the shape of that pattern, how long it takes to form before we break down, right? We've had about that amount of time. And it's really just a function of fiscal, economic, political, demographic factors all weighing together. In general, humans are greedy. And as a result, we are going to do anything in our power to keep things going up, 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 as long as humanly possible. And that's why we drop so hard. That's why we drop so fast at so many points in time. And so if this history continues to play out, you could see us doing one of these. Okay? And a typical rounding pattern might bring us to some sort of low, whether it's a half low or a full risk reward low, maybe by the end of next year. But it would be a severe drop from where we are right now. From 1118 on the Russell, where we ended up today, to 750 is a greater than 33% drop. And that's not abnormal. We've had several of them in the not too distant past. In fact, since the year 2000, we've had 2 of those. So don't think it can't happen, because we've had much worse twice in this millennium. Okay? So, that being said, what do we do about it? Again, the rules of the methodology are there to protect people. All right. Are you down on my picks? Yes. And we'll get to that in a moment. But the methodology is not about my picks going up. It's about your portfolio outperforming the market over time. That's what an investor does. If you don't believe me, ask Warren Buffett. Okay? He doesn't care about what happened today, last week, last month, or last year. He cares about what happens over time. I personally judge myself on a year-to-year basis, and I've had, I think, 2 years out of the last 14 where I've lost money for the year. This won't be one of those years, frankly. I've been following the methodology, and as you'll see in a moment, you'll see what the results of that are if you've followed the rules too. And I know several of you have, but I also know that several of you haven't, and this is for you, folks. Okay, so let's talk about this week. What were a couple of the key events that I saw? Myself, it really boiled down to two big things. I've been talking about China for a long time, so seeing the China GDP numbers come out was important to me. It was actually above the forecast, but the number is slowing down. The success of the Chinese economy is no longer looking good. And if we look at the FXI, it's been flat for years. It's been doing nothing. And in fact, if we close in on this, you see that we've had this drop off starting to happen over the last month or so. That's actually a very sharp correction. If you look from 42.50 down to 36.70 is a 6-point drop off of 42. That's almost 15%. Okay, from one of our hedges, which is obviously a very nice profit to make off of a hedge. And so my concern about China dragging down global growth, as we see, the Russell 2000 is already starting to show signs of that slowdown. And of course, the Russell, by the way, precedes the Dow and the S&P. So the S&P is still doing okay. The Dow is still doing okay. You know what? They were also doing okay in early 2000, before the collapse. The tech market, the internet market rolled over first. The tech market went with it. The Russell went with it. And then later in the year 2000, the S&P and the Dow rolled over. This is the canary in the coal mine. Okay. So, and this is one of the canaries in the global economic coal mine. All right, so this is problematic. And of course, the reason why I don't predict stock movements, and the reason why when we got down to these levels, and people were asking, are we going to a red alert? My answer was no. I cannot issue a red alert until I see definitive signs that things are breaking down in a manner that cannot be fixed. And this last sentence addresses that question. Can this be fixed? Sure. Beijing can unleash further stimulus. And until we see that further stimulus is no longer effective, we cannot issue a red alert. And so people who were, we lost that, bring it back. People who were looking to get hedges in place down here, my message to them was, you missed the point. One of the rules of the methodology is act when you're supposed to act. And that is when the yellow alert is issued, you need to overcome your emotions of euphoria, because inevitably, I'm going to issue a yellow alert when the market is high, not low. And when the market is high, you are going to be high. You are going to be feeling great about your picks. God darn, these things are doing great. This glue is at 750. It's going to the moon. And I feel those things too. And the methodology is there to stop us in our tracks and say, hey, listen, do what you want, stupid, but the rule says this. And all of us make mistakes on the methodology. I honestly believe that I would be up about 60 to 100% this year if I followed every rule of the methodology to a T this year. But because I'm a human being and prone to human error, there are a lot of rules of the methodology I ignored. I didn't sell all of my glue when it hit 750. I put some hedges in place, and that saved me from some of the losses, but the risk-reward charts were topped out. I should have known that at that point the stock wasn't going up anymore, and so I should have at least put full hedges in place, and that would have saved me a six-figure loss. Okay, but what parts of the methodology I did follow did enable me to avoid the full impact. Okay, so you have to overcome your emotion, follow the rules of the methodology, and know this, more important than anything else. And I did a call with a customer today, one of my PTT Elite customers, and it was really clear to me that there was a belief that he could take the rules of the methodology and tweak them to optimize for what he wanted them to be. Well, the rules of the methodology are already optimized. This is what I'm trying to tell you folks. Okay, it took 20 years, multiple mentors, two brilliant mentors, one worth 8 figures at his peak, one worth 9 figures at his peak. And I don't know where they are right now, so I can't say anymore. I just know, what they were worth at some point in time. These are super rich people, super successful people who taught me these lessons. And I incorporated into those lessons further the generous offerings that Peter Lynch and Warren Buffett offer on the internet. And I put all that stuff together, and as my experiences unfolded over the years, 5, 10, 15 years, any mistakes that I made, anything that I said, geez, if I had just done this and listened to this person and done what this person said, everything would be okay. That went into the methodology. So, in other words, the methodology is as good as it can get for most people. And the only people that it is not best for are those who have more knowledge than me, my mentors, Warren Buffett, and Peter Lynch. In other words, a seasoned professional, somebody who's been in the business as long as I have, can probably look at the methodology and say, that's pretty good, and we should probably add this to it. If that does not describe you, if you have not been a Wall Street professional doing business on Wall Street or for Wall Street institutions for 20 years, anything you do to change the methodology will cause you to lose money relative to what the methodology will do. Okay? And we're going to get to this slide in a second to prove it. All right? Okay. JAKKS Pacific. The elephant in the room this week. Okay? This is a report from Sean McGowan. Very smart guy on Wall Street. There's not a ton of them. He's among the better ones. Okay? And look at his commentary here. Okay? Let you read that. Okay? Hopefully you had enough time to read that. This is a man who understands the value of a company versus the movement of its stock. People who focus on the movement of stock are called traders. I am not a trader. I spoke to people during the last couple of days who have tight connections with professional traders, and what they said was that a lot, in fact, the majority of the action in JAKKS Pacific was clearly coming from a couple of constituents. high-frequency traders and retail investors. Now, the high-frequency traders are generally out to do one thing, and that is to manipulate the psychology of investors so that they can make a profit. Read Flash Boys if you want to see the kind of predatory things they engage in. I don't like it, but at the end of the day, it's just business. Okay? If I can convince you to sell me your $10,000 car for $5,000, blame yourself. All right? And that's what they're trying to do here, in my opinion. I don't know for sure if all the stuff that the traders talked about was accurate, because I'm not a trader. But what I do know is this. The report that I put out last night, which came out before Sean McGowan's report, so those of you who complained about how long it took for us to respond, remember this. You are subscribed to a weekly newsletter, and the rules of the methodology say if we don't say anything, nothing has changed. This is because it takes a long time for us to say something if we want to do the research properly. You cannot expect somebody to do a proper analysis in 5 minutes and tell you what's going on. And this is why it's so important to have an investor's mentality. Because an investor looks at a company from the standpoint of what's happening over the long term, not what's happening to the stock this minute, because the two are very disconnected, as we found out this week. Okay? So, were there high-frequency traders trying to scare retail investors out, thus adding to the rush out of the shares? Because there were a lot of people, I suspect, that felt that this company was going to crush the quarter and they were going to make a lot of money, and then they were going to sell the stock and take their profits, and everybody's going to be happy. And that happened for a lot of people because the stock was at $10 in the pre-market, up significantly. But people immediately started selling the stock, immediately taking those profits so that they could, have their party this weekend. Non-investors, traders. And so for every person who sold the stock at $10, they brought out somebody who sold it at $9.75, brought out somebody who sold it at $9.25, brought out somebody, you get the gist. And before long, you had people trying to explain the move by saying that gross margins were weak. Okay, gross margins were weak, but everything else was phenomenal. The business, if you look at this company 3 months ago, or better yet 6 months ago when we selected it, I believe it was 6 months ago, the company is in vastly greater shape. If I told you they were going to have the #1 toy of the holidays 3 months ago, much less 6 months ago, you would have called me a pump and dump artist. And yet here we are, and they have the hottest toy for the holidays. They crushed their estimates. They comfortably exceeded Sean's street high estimate. Okay? But because of the way the numbers looked on the page and the way that management presented them, remember, the management team of JAKKS Pacific is very good at making and selling toys, but they are very poor at talking to investors. Which one's more important? Clearly the former, because that's the business that they're in. If they were horrible at making and selling toys and great at talking to investors, well, this stock really wouldn't be worth much. It might be a good pump and dump stock. Maybe the stock would be exactly where it is right now, but it wouldn't be worth where it is right now. So in contrast, what we determined, and there were 3 of us working on this all day yesterday. That's how long it takes. It was 20 man-hours of work just to analyze one earnings report. And to the best of what we could ascertain, so the gross margin issue, I believe that there were a number of factors that were thrown into the mix because they had such a great quarter, right? The CFO probably looked at the numbers on September 26th and said, geez, we've already made our numbers. Everything that happens from here on out, the last 4 days of the quarter is going to be upside. And believe me, 4 days is a lot. of time to put an upside. Maybe it was 5, 6, 7 days of cushion that they had. That's a lot of days when juxtaposed against a 90-day quarter. And they probably said to themselves, hey, this is an opportunity for us to remove from our liability, our set of liabilities, certain items. And there are accounting rules, but some of them have some flexibility, some room for decision making there. And so if you think about it, this is a company who had the hottest toy of the quarter, whose business across the board, almost every unit that they had, outperformed. And yet they had these charges and they had low margins. How is that possible? If you have something that's very popular and in demand and selling out on a regular basis, the implication is that you have pricing power. You can say, hey, I'm going to raise the price on this thing, and I'm going to make a higher profit on this thing because you want so much of it, right? So the logical conclusion is that there was more to the story than meets the eye with regard to why the margins were lower. And as proof of that, you look at the guidance. The guidance was through the roof. And for some reason, despite them exceeding street high estimates, despite having the top toy for the holiday season, and despite for only selling at 3 times EV to EBITDA, by the way, that number is egregiously low. Okay, for those of you who don't know what an EV to EBITDA multiple is, let's put it this way. It would probably be very easy for Mattel or Hasbro to justify buying this company for 6 times EBITDA and still make a very nice profit on it, which means this stock could be bought out for 14 or 15 bucks, okay, or maybe taken private for 10 or 12 bucks. And this is what a lot of folks are missing here because of this. Because despite all of this positive stuff that happened, and despite the incredibly positive guidance, short-term investors don't look at the change in the business and the turnaround that's going underway. They focus on the one negative thing that makes them think it justifies the downward movement in the stock, because they're afraid that they're missing out on taking their profits, and then they jump out. And then somebody else jumps out, and it's a domino effect. And we saw it in full force over the last 48 hours, where the dominoes just kept falling and falling and falling. And every time somebody sold, it scared somebody else out. It made somebody else say, to heck with it. I can't deal with this anymore. This is BS. I don't know if I can trust this guy or that guy. So I'm just going to get out of the way. But what eventually happens is when the dust settles, the stock is only selling at 3 times EV to EBITDA. And as I've said before, savvy / professional investors will look at this and say, hey, when this dust settles, when those clowns are done selling these shares off at prices that are well below what the company is actually worth, once that stock is completely sold off and very much below what the company is worth, once there's a big difference between the price of the stock and the value of the company, then we will step in. And in fact, there might be a couple of those folks that say, hey, the value of this company right now is such that I can jump in and buy these guys out for $200 million. I've got $200 million lying around. There's been a lot of cheap money going on. I've been looking for a place to put it because the stock market's at an all-time high, and I can buy this company for 3 times EV to EBITDA. Well, heck, the biggest shareholder in this company is an extraordinarily rich Japanese man that's very successful in business, and you can bet he's licking his chops at this today. And who knows? He might act. I don't know. All I know is this stock is at a cheap level. And so even though it was very painful to see my personal holdings decline in value by probably close to 6 figures, if not more. I didn't really count it because it doesn't help. You're not helping your emotions by counting your losses. The thing that you can do best is to follow the methodology and look at the fundamentals. Okay? So as I see the shares drop, and I see the fundamentals improving in this company, I say there's nothing to see here. It's just another day. If there was no such thing as the stock market and I was a shareholder in this company, there would be no stock market for me to see which way the stock was moving. I would just be a part owner in the company, just like a family business. And if this was the results of the family business, I'd be really happy. We'd be having a party this weekend instead of trying to figure out why the stock was down. But that is the nature of the beast. Okay, the stock market is there for a specific reason, and it doesn't make sense all the time. And the reason that it doesn't make sense is irrelevant to me. I'm happy it doesn't make sense, because if it completely made sense, then we wouldn't have cheap stocks to buy. Okay, so that's really it as far as JAKKS Pacific goes. And so let's move on to the next subject, our portfolio. Okay, these are the stocks in the portfolio, and I've included Delia's in here as a stock that got knocked out. I want to be fair about that pick that was sitting that was kicked out of the portfolio because of poor performance. I was wrong on Delia. All of our other stocks have been doing the companies have been doing well. The companies have been doing great. The stocks have not been doing so great. But as I said at the beginning of this videocast, the key to the methodology is not to make money on the picks, but to make money on your portfolio. And there's a lot that goes into that. One is having the right mix of picks and hedges. And of course, the yellow alerts tell us that we should be hedged. And those hedges have been very profitable, as you saw in the past videocasts. And the Russell's performance is what I like to judge my performance against. Because if I am hedged, then I can outperform the market simply by pitting my stocks against their stocks. These 2,000 stocks against these 6. And that's the game. If your picks beat their picks, you can win every single year. Okay? And if on top of it you can get some good timing in terms of markets being at high levels based on the fundamentals of the market relative to the price level of the market, then you can make even more money. As I've discussed from 2000, 2001, 2007, 2008, when our clients did phenomenally well, made tremendous profits, 35+% in 3 of those 4 years, and a profit in the 4th year, even though the markets got wiped out during those years. And that's all because being able to play these risk-reward levels versus the fundamentals, which is the hardest part. That's what took me 15, 20 years to master. Okay, so let's look at what we've got here. All right, here's each company, here's each stock, here's the date we picked them, here's the price on the day we picked them, here's the current price as of this study, which I believe was done for me this morning. Here's the current performance. Here's the Russell's performance since the date of the initiation. And in the case of Delia's, from the date of the initiation to the date that we closed out the position. So it's a direct apples-to-apples comparison of our picks versus the Russell. So let's take a look. Ignore everything to the right of this arrow for now. Let's just look at the absolute performance of my picks. Well, this doesn't look too juicy at all. We're only 2 for 6. Out of our 6 picks, 4 of them are down. Well, that's horrible. Absolutely horrible. Now, granted, our two core picks are up 63 and 41% respectively, which probably, I didn't do the math on this, it has to outweigh the rest because this represents 20% of our portfolio, 10 plus 10 on the core picks. And then the other picks are momentum picks, 7 plus 7, plus two speculative picks, which is 1 plus 1. So that's a total of 16% of our portfolio that was down 12%, 3%, 11%, and 28%. So the average decline here is probably, on a weighted basis, approximately 10%. We've got the negative 12 and the negative 3 taking up most of the bulk, and then very tiny 1% positions in JAKKS, in Delia's. Taking the JAKKS is actually a 7% position. AeroGrow is a 1% position. So we come up with about the same numbers, actually. This is about 10% decline. Against a 63% gain and a 41% gain for our 10% positions, which add up to 20%. So 20% of our portfolio was up more than 50% on average, and 16% of our portfolio is down about 10% on average. So you could say all of my picks are down. Well, they're not all down. 4 out of the 6 are down. And you can say I'm losing money because the average return is down. But that's not true because the average of these picks are up. And these picks are the most important ones because AeroGrow and Delia were 1% positions. Okay, you start to see how the methodology's rules come into play. If at this moment you are saying, man, you're just making excuses, then you haven't read the methodology. The methodology's been there for years. It's been sitting there for you to read. And if you haven't read it, then everything I just said makes no sense. So take responsibility for yourself if that's the case. Because I'm here to do my job and take responsibility for this terrible Delia's pick that I made. That was my fault. You blame Mark Gomes for that. Okay? That pick was down 28%. At the same time, the Russell was down 2%. Delia's underperformed the market by 26%. That is a terrible pick by Mark Gomes, and I take responsibility for that. But the methodology told us that that pick was a 1% position, and so hopefully, if you read the methodology and follow the rules, this 26% underperformance only had a 1% impact. So you didn't lose 26% on your portfolio, you lost 1% of 26%, which is 0.26%. And this is how the methodology saves our butts from ourselves, because it keeps us doing the right things despite what our psychology is trying to tell us to do. Okay? So let's move on to the performance of our picks versus the Russell individually. You get QAD up 63%. Russell, during that time, up 18%. The difference, 45%. Big outperformance. Glue Mobile, the source of many people's pains. How many of us have endured incredible amounts of pain since its high on July 1st? It's almost November 1st. 4 months of down, 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 down. I can't take it anymore. Well, the stock's up 41%. If you got our PTT alert on October 24th and bought the stock and fell asleep and woke up today without the benefit of a stock chart, you'd be like, oh my god, the stock is up 41%. That's phenomenal. And if somebody told you that during that time, it's actually the 1-year anniversary of that pick, over the course of the last year, the Russell gave us a 0% return, you'd probably be surprised because the Russell's been going up every year for the last 5 years. But no, the Russell has gone nowhere. And Glue's up 41%. And of course, that is a 41% outperformance. Understand what I'm saying? Let's move on. AeroGrow, a 1% position, down 12% from our initiation price. The rules of the methodology, I know many of you jumped in at a higher price, but the rules of the methodology say very clearly, if you don't believe me, go back and read it. It is said from the beginning, don't chase. Because you will have an opportunity, more likely than not, to get in on this stock again at a price that's close to, if not lower than, the initiation price. And why? Because there's only a couple thousand of you paying for this service. And if you don't compete with each other, and if you don't share this information with the public, you 2,000 folks have information, have PTT information, that millions of people do not. And what ends up happening is if you guys fumble over each other and stumble and rush to buy the stock, and the stock goes from $4 to whatever it went to, there are millions of people out there that are going to say, where's the news on this? There's no news on this? Oh, some company called Poised to Triple picked it? That must be a pump and dump. I'm going to short it. So guess what? By sharing the pick, by chasing the stock, all you have done is made yourself a target to lose money. And the rules of the methodology are meant to keep us from doing that. There's a reason why we say don't share the picks. There's a reason why we say don't chase the stock. And there's a reason why, as evidenced by this 12% loss on the position thus far, that we say that speculative positions are supposed to only be 1%. And as you find, the Russell has actually been down 1% since we picked AeroGrow. So the market's down, AeroGrow's down. Total performance on AeroGrow, negative 11%, but it's only a 1% hit to the portfolio. So it's basically a negligible loss versus these 45% and 41% outperformances on QAD and Glue Mobile that each had a 10% impact on our portfolios. Okay? And I'll show you the results of that, what that means in a second. We're getting down to the final analysis here. Okay? Mattersight, down 3%. But the market has been down 7% in the same time frame. Mattersight is a winner. Mattersight is a winning stock. It's down 3%, but it is vastly 4% outperforming the market in a 7-month time frame. If you make 4% every 7 months, you're making 8% a year. And that is more than what the market makes per year. And more importantly, most people don't understand the potential of Mattersight. I'm not going to get into it here, but we, as most of you know, we hired a Harvard expert to do a deep dive. We are going to be sharing the results of that deep dive soon, and it is fantastic. Okay? So I have no problem with where Mattersight is. Stock-wise, it is outperformed, and that is a positive thing. JAKKS Pacific, our little elephant in the room this week, down 11% now. It was up at the beginning of this week. It was up tremendously. It was a $10 stock before the market opened on Thursday, which was a big jump from the 773 initiation price. But the panic selling, the inexplicable move versus the fundamentals we went through here drove the stock down, and now we're very quickly down 11% as of the time of the study. But the Russell's down 4% also. So we're only down 7% on JAKKS relative to what the market has done in the time frame. So if you followed the rules of the methodology and put your hedges in place, then your losses have been mitigated by the market's decline from your profit on shorting the market. And so the 7% loss on a 7% position becomes just a 0.49% hit to your portfolio. 0.5%. All right. So let's keep that in perspective. The methodology, if you've been following it, has enabled you to limit your loss on JAKKS Pacific has obviously seemed so traumatic this week. Limit that loss to 0.5% of your portfolio. And of course, Delia, the awful pick I already went over. We talked about that earlier right there. So if we take the size of each position, QAD, Glue Mobile being 10%ers, these other ones being somewhere between 1 and 7%, and weight the performance, the size of those positions, our portfolio weighted delta between the success of our picks versus the success of the market has been a plus 22%. So even though 4 out of our 6 picks are down, we have outperformed the market by 22%. And now you've got this one other number sitting here, annualized outperformance. Basically, the average pick in our portfolio has been in the portfolio for less than 1 year. Of course, most of you have been customers for less than 1 year. Okay? So if we take this number and annualize it and say if the average pick had gone 1 full year, what would this 22% be? And the answer to that is 29%. So we have been outperforming the market by 29%. If you haven't been following the rules of the methodology, you're nowhere near this number. I can tell you that my personal portfolio is currently up 26.5% year to date. And that is a mix of following the buy and hold rules of the methodology, which I just went through here, in addition to some risk-reward hedging at certain points. Selling calls, taking some of the tertiary picks off the table, things like that. You can make a little bit of money here and there. Plus, we have the PTT Elite portfolio that has had some great shorts in there. We shorted King Digital. We shorted Pandora, which was down today. And we'll maybe give you some insight into others. I thought this was just a couple of examples for you. And so even though the methodology would give us 29% outperformance, I'm still only at 26.5, and that's because I haven't followed the methodology fully. I've done some things wrong, and I've done some things right, and net I've come close to this 29% number. If everybody in the PTT customer base, and this is the moral of the story, if all of you read the methodology, if you want to become a millionaire, or if you're a millionaire and you want to make more millions, and you want to keep those millions, and maybe you want to become a billionaire like Buffett, if you want those things, ask yourself, is it worth it for me to read and learn 35 pages of material? Because that's the methodology. It's 35 pages. And if you can read those 35 pages and commit them to memory and follow those rules like any other game, then you can make millions. You can be up 29% versus the market over the last year, instead of saying that you lost so much money on these picks. Okay, I heard somebody saying that they took some enormous hit to their portfolios, like a 13% hit to their portfolio this week. And the only way that could have possibly happened is if you had 100% of your money in JAKKS Pacific. The methodology says 7%. If you put 100% of your money into JAKKS Pacific, quite honestly, you are gambling and or desperate. And there is no room for desperation or gambling in an investing environment. And in fact, if that is the theme of your life right now, desperation and gambling, please, please do me a favor and do not subscribe to PTT Research any further, because I don't want to feel responsible. I feel bad when I hear these stories, because I feel a responsibility to make sure that you have read the methodology and learned it. And when I hear stories like that, I say to myself, I have failed to communicate how important the methodology is to gaining these successful numbers. But the reality is, that's not true. If we had $1 for every time I said the word methodology, I'm sure some of you are sick of it by now, we'd have a lot of money sitting on the table. Those of you who are sick of me saying the word methodology, either know the methodology and don't have to listen to this video. Congratulations, thank you. Please continue being a customer. You are the folks that I do this for and will continue to do this for. But those of you who are sick of the word methodology because you haven't read it and because you've taken these heavy losses, please change your tune or don't be a customer. I don't want your money. I don't want anybody's money, in fact. The money that's coming into PTT is going towards research to find more picks to get deeper in, to do the sort of work we did on Mattersight so that you folks and us can have greater confidence in the stock so that if it goes down, we know what to do. Not panic because we don't know what to do, but know what to do because we know what's going on at the company. That's where the money's going. I don't need money from people who aren't going to follow the methodology. I don't want to hear about people who are not successful. I want to hear about success, and the methodology has been successful, more successful than I have been personally, which gives me the incentive to stick harder to the methodology, to follow those rules, even better than before, because I find that every time I stray from it, even a little bit, I lose a little bit of that outperformance. And that's why I say, through ups and downs, through thick and thin, PTT Research is here to teach you the lessons that made Peter Lynch famous and Warren Buffett a billionaire. Stick with us, we'll stick with you to teach you more of these lessons and to give you more of this research to make millions, keep your millions, and who knows, maybe you too will soon be a billionaire like Buffett. And until next time, this is Mark Gomes wishing you great prosperity, and we'll talk to you soon. Take care.